Welcome back to the Wall Street Podcast. For this deep dive, we're distilling the key insights from the Wall Street Journal's weekend edition, the one from July 26-27, 2025. Our goal, as always, is efficiency, giving you the critical financial and policy shifts without the extra noise. Let's get into it.
Okay, so starting off, we're really seeing a tale of two economies, If you look at market dynamics, the S&P 500 hit its 9th record high just this month, the NASDAQ, 13th. Weekly gains were pretty strong too. S&P up 1.5%, NASDAQ 1%, and the Dow added 1.3%.
And financial conditions are still, well, remarkably loose, it seems. Wall Street trading desks actually saw a 17% jump in aggregate revenues for Q2. Goldman and Morgan Stanley did even better, right? Over 20% growth in equities trading alone.
That's right. Huge numbers there.
And interestingly, we're also seeing meme stocks pop up again. Names like Kohl's, GoPro, Open Door, even Krispy Kreme making noise.
Yeah, quite the mix. But at the same time, Main Street businesses, they're tightening their belts, they're grappling with tariffs, worries about the labor market. It's a different picture.
That really is the key tension here. So this divergence between Wall Street soaring and Main Street struggling, even under, broadly speaking, similar federal policies. What's the core reason for that gap widening?
Well, I think the fundamental thing to grasp is how Wall Street profitability is now almost directly linked to market volatility. Things like tariffs, uncertainty. That creates churn, which means trading revenue for the big financial players. Main Street businesses, meanwhile, they don't have the scale or, the sophisticated hedging tools. They just absorb those costs, the tariffs, the labor pressures.
So the volatility itself becomes a profit center for one, while being a major headwind for the other.
Precisely.
Okay, let's shift gears a bit to corporate performance and strategy. Seeing some interesting moves. Volkswagen, for instance, apparently proposed some U.S. investment, hoping for tariff concessions. This comes after their first half earnings fell sharply.
Right. And Meta, Facebook's parent, they announced they're stopping political ads in the EU starting this October. They're citing new regulations over there as basically unworkable.
The regulatory angle again. But what?
And CME Group, they won a big legal fight, avoided potentially $2 billion in damages related to their shift from floor trading to electronic markets.
Good for them. But earnings generally were a mixed bag in Q2.
Very mixed. You had Charter Communications missing earnings estimates, and they lost, 117,000 internet customers. Centene actually swung to a loss and had to drastically cut their full-year outlook. That might signal some instability among health insurers.
Okay, but on the flip side...
On the flip side, HCA Healthcare beat expectations and raised its guidance for the year. Verizon also beat profit forecasts.
But not everyone's optimistic. Airlines like American and Southwest are bracing for third-quarter losses.
Yeah, seems the domestic travel boom might be slowing down. They're cutting fares because consumers are being more cautious, maybe delaying summer trips.
So thinking about companies like Meta dealing with EU rules and airlines cutting fares, what are the key takeaways here? How are big corporations navigating these regulatory and consumer headwinds?
Well, Meta pulling back on EU political ads really highlights that ongoing friction, doesn't it? Between big tech and regulators trying to impose new rules. They called the complexity untenable. And the airlines cutting fares. That's a direct reflection of a more cautious consumer. People are watching their spending. So companies have to react, adjust pricing, maybe service models, just to keep demand up. It's adaptation in real time.
Adapt or face the consequences. Okay, let's look at policy and global economics. Some major developments here. Japan committing $550 billion to invest in strategic U.S. industries, energy, semiconductors. That's a huge number.
It is. And the White House statement was interesting, too, saying the U.S. would retain 90% of the profits from that.
We also see the Trump administration potentially targeting more universities like Harvard with fines over campus anti-Semitism concerns, using that Columbia settlement as a kind of model.
And on the health front, HHS Secretary Robert F. Kennedy Jr. is apparently planning to replace the entire U.S. Preventive Services Task Force. The rationale given was viewing them as too woke.
Reporting that as stated. And finally, a national security point. Deploying those two age-aid missile defense systems to Israel back in June during the conflict with Iran.
Right, they fired over 150 interceptors.
And that action apparently revealed some, quote, alarming gaps in U.S. supply stockpiles. Something to watch. Okay, let's circle back to that Japan deal. $550 billion. That's more than double their prior direct investment, right? How does this specific deal potentially reshape how we think about international trade deals and maybe presidential influence?
Well, it's significant not just for the amount, but for the structure. This isn't a typical trade agreement. It's a direct bilateral investment, seemingly quite tied to executive discretion, with a specific profit retention clause for the U.S. It kind of bypasses those broader multilateral frameworks. It suggests a model where executive power can directly shape large-scale international capital flows for specific national aims, though, the details are still a bit vague. Is it loans, guarantees, especially considering Japan's own debt situation? Lots of questions remain on the implementation side.
So a potentially powerful new tool, but details TBD. Interesting. All right, so wrapping up today's deep dive, we've touched on quite a bit. Strong markets, but Main Street pressure, companies navigating regulations and consumer shifts, and some really impactful policy and global economic moves.
It definitely underscores a complex picture right now.
So the final thought we want to leave you with today is this. In an era defined by these massive capital flows, like the Japan deal, alongside very targeted, sometimes quite sudden regulatory actions, how might this fundamentally change the competitive landscape? And maybe more importantly for you, where will the new investment opportunities and risks lie in the years ahead? Something to consider.